Welcome to my channel, your ultimate destination for mastering finance and business management. Whether you're looking to grow your wealth, build your business, or sharpen your skills, we've got you covered with practical tips, expert insights, and actionable strategies. Let's embark on the journey to success together, the optimal order of investing your money. Are you ready? Hello everyone, and welcome back to the channel. If you're feeling overwhelmed about where to start investing your money, this video is for you. Today, we're diving into the optimal order of investing your money step by step, so you can grow wealth strategically. A lot of people lose money because they invest in the wrong order. Think about it, does it make sense to invest while drowning in credit card debt? Or invest in stocks without an emergency fund? In this video, I'll guide you through 9 key steps from building a safety net to making advanced investments like real estate. Stick around till the end, because I'll share bonus tips to supercharge your financial journey in 2025 and beyond. Now let's get started. Build your emergency fund. The first step before you start investing is to build an emergency fund. Why is this important? Let's say your car breaks down or you lose your job without an emergency fund. You'll turn to credit cards or loans. An emergency fund covers 3 to 6 months of your expenses. Start small, save $1,000 first. Then, gradually aim for 3 months' worth of expenses. Start small, save $1,000 first. Then, gradually aim for 3 months' worth of expenses. Example, if your monthly expenses are $2,000, aim for $6,000 in a high-yield savings account. Pro tip, use automated transfers to move money into savings every payday. A little adds up over time. Pay off high-interest debt. Now that you have your safety net, it's time to tackle high-interest debt like credit cards or payday loans. Here's why. Most credit cards charge interest rates of 20 to 25%. No investment can consistently earn you that much. If you're paying 25% interest, but investing for an 8% return, you're losing money. Steps to get rid of debt fast. List all your debts with their interest rates. Use the debt snowball method, smallest debt first, or avalanche method, highest interest first. Make extra payments whenever possible. Example, if you owe $5,000 at 20% interest and pay only the minimum, it will take years to pay off and cost thousands in interest. Instead, put every extra dollar towards that debt. Employer for 101k match. Free money first. Next, we're grabbing the easiest return on your money, your employers for 101k match. This is free money. Many employers will match 50 to 100% of your contributions up to a certain percentage. Example, if you earn $50,000 annually and your employer matches 100% up to 5%, that's $2,500 per year of free money. Don't leave it on the table. Pro tip, contribute at least enough to get the full employer match. It's an instant 100% return. Max out your IRA. Once you're taking full advantage of your 401k, it's time to invest in an individual retirement account IRA. Traditional IRA, contribute pre-tax dollars now, pay taxes in retirement. Roth IRA, pay taxes now, withdraw tax-free later. Contribution limit, $7,000 per year in 2025 if you're under 50. Which is better, Roth IRA, if you expect to be in a higher tax bracket later. Traditional IRA, if you need the tax break now. Pro tip, start investing early. Even $6,000 a year can grow to $1 million over 30 years with an 8% return. Contribute more to your 401k. Once you've maxed out your IRA, it's time to revisit your 401k and start contributing more. Most people stop at their employer match, but the real magic happens when you max it out. For 2025, the annual contribution limit for a 401k is $23,000 if you're under 50 and $30,500 if you're over 50. Why maxing out matters? Tax savings. 401k contributions lower your taxable income. For example, if you earn $80,000 and contribute $23,000, you're only taxed on $57,000, saving thousands in taxes. Compound growth. Investing earlier allows your money to grow tax-deferred for decades. Real example, let's say you invest $23,000 per year for 20 years with an average return of 8%. You'd end up with over $1.1 million, all because of tax-advantaged growth. Pro tip: increase your contributions gradually. Start by raising at 1 to 2% each year or after every raise until you hit the max. Your future self will thank you. Build a diversified brokerage account. After maxing out your retirement accounts, it's time to build a taxable brokerage account. A brokerage account is flexible, no contribution limits, no restrictions on withdrawals, and it allows you to invest in a variety of assets, like index funds, low-cost options tracking the market, like the S&P 500. ETFs, exchange-traded funds that provide instant diversification. Dividend stocks, stocks that pay regular cash returns. Example investment strategy: allocate 60% to broad market index funds, 20% to dividend-paying stocks, 20% to high-risk growth opportunities. Key benefits: liquidity, access funds anytime for major purchases or emergencies. Tax efficiency, long-term capital gains are taxed at lower rates than regular income. Pro tip: use the dollar-cost averaging method. Invest a fixed amount monthly to reduce the risk of market volatility. The earlier you start, the more time your money has to grow. Real estate investments. Step 7. Real estate, one of the most powerful ways to build wealth. But you don't need millions to start. Here are 3 options. House hacking: buy a multi-unit property, live in one unit, and rent out the others. The rental income covers your mortgage. Example, a $300,000 duplex with a mortgage payment of $2,000. Rent one unit for $1,500, you're only paying $500. REITs, real estate investment trusts. These are like stocks, but for real estate. You can invest in commercial properties, apartments, and storage units with as little as $100. Short-term rentals. Platforms like Airbnb let you rent out part of your home for extra cash. Benefits of real estate: rental income provides cash flow. Property values appreciate over time. Real estate offers incredible tax advantages. Pro tip: start small, use leverage wisely, and reinvest rental income into more properties. Real estate can provide a path to financial independence, paying off low-interest debt or mortgage early. Now that your investments are growing, you can look at paying off low-interest debt like your mortgage or student loans. Should you invest or pay off debt? Here's how to decide. If your loan interest rate is under 5%, focus on investing first. You'll likely earn a higher return in the market. If paying off debt gives you peace of mind, prioritize it. It's a guaranteed return. Example, you have a $200,000 mortgage at 4% interest for 30 years. By making just one extra payment per year, you'll save $35,000 in interest and pay off the loan 4 to 5 years early. Pro tip: if you're unsure, split your extra cash, put half into investments and half toward debt. Investing in yourself. Finally, one of the best investments you can make is in yourself. Why? Because improving your skills and knowledge can multiply your earning potential. Here's how to invest in yourself. Education. Take online courses to learn high-income skills like coding, design, or marketing. Certifications. Adding certifications can increase your value at work and boost your income. Start a side hustle. Use $1,000 to start a small business like freelance work, dropshipping, or content creation. Real example, a designer took a $500 course in UX design and landed a job paying $80,000, tripling their previous salary. Pro tip: never stop learning. Personal growth is the key to increasing your financial freedom. Now you know the optimal order to invest your money step by step. Follow this strategy, and you'll grow your wealth smartly, safely, and sustainably. If you found value in this video, hit like, subscribe, and share it with someone who needs it. Let me know in the comments, what's your first step after watching this? See you in the next video. Thank you for watching Sapric Your Finance. If you found this video helpful, don't forget to like, share, and subscribe. Hit the bell icon so you never miss our latest insights on finance and business management.